Welcome, Singapore investors. Are you drowning in headlines and trying to make sense of what truly matters for your SGX portfolio? Or maybe you're just curious about how today's market swings affect your investments. This is the Investing Iguanas Daily SGX Market Digest for August 4th, 2025. I'm Iggy, here to help you make sense of the market's moves and what they mean for your money. Today marks another upbeat session for the Singapore market. The Straits Times Index, or STI, closed at 4,171.6, up a solid 0.43% from the previous session. This continues a strong trend. The STI has climbed 3.5% in the past month and is almost 29% higher than a year ago. Local investors remain upbeat, with Singapore's economy forecast to grow 2.8% this year, driven by electronics, technology, and banking, even as global uncertainties persist. The electronics sector, in particular, is riding on renewed demand for AI and automation, with global semiconductor sales projected to continue their robust growth. But it's not all smooth sailing. Volatility is still the name of the game, and sector moves have been anything but uniform. Let's break down the action and see which companies shape the day's headlines. Let's start with Singapore Airlines, or SIA. The flag carrier has been front and center after a string of analyst downgrades. UOB Kay Hian, Maybank, and CGS each cut their ratings to sell, trimming target prices to between 6.03 and 6.80. The core issue? SIA's recent quarterly profit fell almost 59%, as travel demand cooled following a post-pandemic surge. Despite these challenges, SIA's share price inched up 0.3% today to close at 6,082. For context, that's a far cry from the sharp moves we saw during pandemic years, but it's still seen as a cautious vote of confidence from some investors. SIA's current PE ratio sits at 7.4x, and its dividend yield approaches 6%. Looking ahead, the company is facing rising costs from fuel and labor, while still contending with cooled but steadily rebounding international travel. If you're watching SIA, the main questions are whether it can contain costs and continue paying healthy dividends, both areas to watch closely as you weigh any new investment. Next, let's zoom in on NIO, a name that's increasingly familiar to Singapore investors in the growing electric vehicle, or EV, sector. NIO reported record July deliveries, over 21,000 vehicles, a 25% jump year on year. This included contributions not just from its premium NIO line, but strong growth from its Envo and Firefly sub-brands aimed at broader price points. NIO's share price closed 5.5% higher at US $4.79 just before the announcement, reflecting optimism that the company can push through recent market volatility. Yet the big picture remains uncertain. NIO's stock is still down about 17% for the year, trailing both the broader market and rival Chinese EV makers. Investors are carefully watching two things. Can NIO turn delivery growth into profits? And can it steal market share from global giants like Tesla? NIO's strategy of launching lower-priced and mass-market models is bringing in customers, but operational losses remain high, and aggressive R&D spending is eating into margins. The next quarter's earnings will be a key moment, but right now, NIO's stock is a high-risk, potentially high-reward play, especially as the EV price war across Asia and Europe intensifies. Let's turn to Genting Singapore, a heavyweight in the gaming, resorts, and entertainment sector. Today, the company announced a big leadership shuffle. Lee Shiru was promoted to president and COO, with Ong Swat Ching stepping in as CFO. Genting's share price closed flat at $7.35, a level it's hovered near for some time. Consensus among analysts is that Genting remains a quiet but important play on Singapore's tourism and MICE, meetings, incentives, conferences, and exhibitions, recovery. The share has lost about 12% in the last year, but research houses see a price target near $1.05, indicating upside if earnings rebound. Genting's valuation is moderate, with a forward PE of 15, and it remains highly liquid. For now, investors seem to be waiting for a fresh catalyst, perhaps a rebound in international visitor arrivals or a strong quarterly result, before making any big moves. Now let's check in on City Developments Limited, or CDL, the property heavyweight with a growing global footprint. CDL's story lately has been all about aggressive expansion and savvy asset recycling. Executive Chairman Kwek Leng Beng revealed plans to triple the group's hotel portfolio to over 500 hotels worldwide, up from 160 today. Shares have rallied hard on this vision, soaring 25% in just the past month, and are now up 19% for the year. CDL closed the day at 6,012, tracking just below its recent 52-week high. However, the skepticism in the market comes from its high price-to-earnings ratio, almost 30, which some see as a warning sign after such a rapid run-up. Recent moves, like the big-ticket sale of CDL's stake in the South Beach mixed-use development to IOI Properties for $834 million, have helped strengthen the group's balance sheet and given it ammunition for further growth. The next milestone, how these funds will be redeployed, and whether hotel occupancy and residential sales can keep momentum going, especially with global interest rates expected to moderate by year-end. The market's top gainers included Keppel Corporation, which hit a 5-year high on the back of better-than-expected earnings from its infrastructure, logistics, and real estate segments. Keppel's massive transformation into a global asset manager is beginning to pay off. Meanwhile, banks like DBS and UOB saw some profit-taking as investors rotate into sectors with higher growth momentum. The defensive play on the Singapore Exchange, or SGX, is benefiting from increased trading volumes and listing activity, which tend to spike during volatile episodes. Let's take a step back and focus on the bigger economic picture shaping today's moves. Singapore's GDP expanded by 4.3% in the last quarter, outpacing even elevated expectations. The city-state's electronics sector remains the star performer, with manufacturing and precision engineering enjoying a 5.5% boost from AI, semiconductor demand, and early-year inventory restocking. The financial sector is set to benefit from lower global interest rates, and a new crop of tech startups and real estate investment trusts are hitting the SGX, reflecting wider investor appetite for yield and growth. Yet, risks loom. Geopolitical frictions in Asia, rising U.S. tariffs, and weaker consumer spending across parts of Europe and North America are all potential headwinds for exporters and global-facing companies in Singapore. Inflation remains tamed at under 1%, but wage and property cost growth are something to watch if the economy keeps heating up. So what should investors do with all this data? Here's my take. Today's SGX movements show a market that's still optimistic but getting more selective. The standout results from NEO and CDL point to the rewards of betting on sectoral winners and firms with a clear vision for global expansion. On the other hand, the struggles at SIA and muted action at Genting remind us not to ignore risks or overpay for companies whose outlooks are clouded by uncertainty or rising costs. For retail investors, the lesson is simple. Don't get caught chasing yesterday's winners or reacting blindly to headlines. Instead, focus on companies with solid fundamentals, an edge in their sector, and a track record of pivoting in changing environments. Keep your portfolio broad across hot sectors like tech and finance, but don't ignore steady compounders in infrastructure or property. That wraps up your SGX Market Digest for August 4th, 2025. Navigating daily market shifts is key to growing your wealth right here in Singapore. If this digest gave you value and you want early access to my real-time analysis and urgent market insights, check out our premium membership. It's just $1 a month, less than a kopee. Your daily edge delivered straight from my desk. Before you go, like this video, share it with fellow investors, and leave your thoughts in the comments. I read every single one.